Hello and welcome everyone. This is the webinar for what the One Big Beautiful Bill Act means for horse and farm owners. We're going to give everyone just a minute or two to keep joining. But in the meantime, I want to tell everyone just a little bit about what today will hold. We will be hearing from Joe and Jen from our tax team at Dean Dorton, and we'll be covering everything about the new bill of the One Big Beautiful Bill Act and what it means for horse and farm owners. If you have any questions throughout the webinar, please use the chat feature. It's going to be at the top corner or the top toolbar on your screen. Hit that and submit any questions. We will be monitoring it throughout the presentation, and we'll make sure to share any technical questions with our presenters at the end of the presentation. If we do not address your question during today's presentation, contact information is included at the end of the materials. So please reach out after as needed. The next thing that's super important about today is that this is being offered for 1 hour of CPE credit. While we're still waiting for people to trickle in, we need you to check in. If you're attending for CPE credit, please scan the QR code on your screen. You will be checking in for the session. Just point your phone's camera at the QR code to join directly. You can also go to deandorton.cnf.io and tap the session titled What the One Big Beautiful Bill Act Means for Horse and Farm Owners, and you will join the session that way. Throughout the session, there will be code words that will be populating. You must submit the code words to this QR code to admit that you are here and attending and staying focused. This is how we determine our CPE credit. If you miss a code word, unfortunately, that means you will get less time for your CPE credit. So we want to make sure we get all code words submitted. The fun thing about the code words, they're not words, they are numbers. So code words is a little misleading, so be prepared for a set of numbers that you will be submitting. Any questions about that, we will be monitoring the chat, and I will put this information in the chat as well. The other thing that we want to let everyone know is that this webinar is being recorded, and we will be doing some kind of follow-up with it, so please be on the lookout for any information about that. If you have any questions, please reach out to your Dean Dorton advisors. I know there is a lot of information going around right now around this bill and this act, and we want to make sure everyone stays informed. And we are just a really good subject matter experts at this thing, and we're really excited to share all the information with you as well. Thank you so much for joining us today. Do not hesitate to ask questions. And without further ado, I give you Jen Shaw.
Thanks, Julia, and thanks to everyone for joining. So good afternoon or morning, depending on where you're joining us from. For those of you who do not know me, I'm Jen Shaw, and I lead our firm's equine practice here at Dean Dorton. I'm joined today by my colleague, Joe Darty, who leads our firm's equine tax practice. Dean Dorton is a top 100 CPA and advisory firm, and we have the privilege of working with over 1,000 equine participants across the country and around the globe on their tax, accounting, technology, and operational consulting matters. So today's focus is on the One Big Beautiful Bill Act, which we're now calling the OB3, which sounds a lot better than trying to say all those words, and its particular impact to equine industry participants. I've got a CYA disclaimer here that, you know, we're going to talk about things from a general perspective, but I'd encourage you to talk to and recommend you talk to your own tax advisors who are familiar with your situation before making any decisions. And we are focusing today on equine business operations versus equine hobby operations. So just a little bit of information there. Here's the agenda that we plan to cover today. We've tried to include topics that are most impactful to horse and farm owners that came out of the recent legislation. There are many other general tax provisions included in OB3, like extensions of the reduced tax rates, some changes to charitable contributions, increased estate tax exemptions, for example. We're not going to cover those today because they're really part of a broader discussion. But much of what we cover today is not necessarily equine industry specific, but we believe, well, there's a couple exceptions to that, but we believe would be most impactful for industry participants. So looking at the agenda, we'll first cover the fun stuff, the new and enhanced federal tax incentives, for depreciation, some investment limitation calculations, etc. Then we'll get into some updated tax form reporting. That's primarily for Form 1099s. We'll talk about some key tax limitations which may apply, and then briefly look at some key non-equine considerations, since not everyone who owns horses and farms may be also involved in other industries. And then we'll wrap up with some action items based on our discussion today. So we'll go ahead and get started. The first topic that we're going to talk about is bonus depreciation. And depreciation is merely a term that basically calculates when I'm able to deduct the purchase price of an asset. And bonus depreciation accelerates the timing of when I can deduct my purchase price. So the higher the percentage, the larger amount that I can deduct when I place that asset in service. So prior to OB3, the legislation that was signed into law by Trump on July the 4th, the bonus depreciation was 60% in 2024, for those of you that are still working on 2024 tax returns, and then 40% for calendar year 2025. It was also scheduled to go to 20% in calendar year 2026. With the passing of the OBBBA, it now is 100% for qualifying assets acquired after January 19th, 2025. And it makes this permanent. So we no longer, we no longer have to guess what the percentage may or may not be. As of right now, we have 100% bonus depreciation as permanent. This was a big win for the equine industry, but also for many other industries that are capital intensive when purchasing assets. So the big thing to note for 2025 is that it technically applies, this 100% applies for assets purchased after January 19th, 2025. So if the contract is in place prior to that date, then you have to look at the applicable bonus percentage. And we'll get into some examples of what that means. All right. So there's a concept for just claiming depreciation, that an asset has to be placed in service. So for horses, what does that mean? You have to purchase it, and you also have to place it in service. So for racing prospects, it's when the horse begins training, typically the fall of their yearling year, or when the horse begins racing at 2. For sport horses, it's when the horses begin training, or when the horses begin competing. That age varies depending on the horse. And then for breeding stock, it's when the horse is available for breeding. So any of the above are accepted by the IRS as being placed in service. But once you choose a methodology, you should be consistent. And so, for example, if I purchase a yearling in 2024, and my policy is to place that yearling in service their 2-year-old year when they begin racing. So in 2025, that yearling wouldn't qualify for the 100% bonus depreciation because it was acquired prior to January 20th of 2025. It would qualify for the 40% bonus depreciation. If I purchased a mare at the Keeneland January 2025 sale, which took place January 13th through the 15th, but I paid for that mare after January 19th, that mare is still subject to a 40% bonus depreciation number because I had a contract in place. I technically purchased it prior to the January 19th date. So just something to be aware for 2025 specifically. I know that when this happened, when the bonus depreciation was first increased to 100% back in late 2017, if you were audited, the IRS did take a look at that. So you'll want to make sure that you look at the appropriate appropriate bonus depreciation percentage to use. But the good news is for most horse purchases in 2025, likely will qualify for the 100% bonus depreciation, which again is now permanent. And it's nice to have some clarity this early in the year versus like the last week of December, which sometimes happens. Most horses do qualify for bonus, but there are a few exceptions so that do not qualify for bonus. If you previously owned the horse, that horse would not qualify. If the horses are used predominantly outside of the U.S., or you purchase it from a related party or received via inheritance or gift, Horse is not eligible to be placed in service, like a weanling is not eligible, it's not doing anything yet. It sort of sits there on the books for a little bit. And then horses that are inventory, not placed in service. So typically are pin hooking, like your weanling to yearling pin hooks, that type of thing. So those are some exceptions to the bonus depreciation rules. Other common equine assets that may qualify, things like equipment, fencing, land improvements like roads, underground utilities, barns. This is very helpful on farm purchases. So, we often work with folks who are buying a farm to make sure that they either get a detailed appraisal or afterwards a cost segregation just to allocate to the various assets that are eligible now to be written off 100% in the year of purchase. Bonus depreciation is so impactful for income tax purposes because it may be used to create or increase a tax loss. And in fact, for many farm owners, depreciation is one of the largest income tax deductions on the annual tax return. So it's very beneficial. And it's not prorated based on the placed in service date. So if I buy a horse on December 1st, I can claim the full amount if it otherwise qualifies. So again, it's very helpful. Again, on some of these assets, like if you're doing significant barn improvements, if you had a contract in place prior to January 19th, January 20th of 2025, you'll want to look at the applicable bonus percentage to use because you likely will not qualify for the 100%. And again, the IRS would look at that from a just making sure it's appropriate perspective. So that's the biggest, the biggest, I think, impact from an industry perspective, again, not equine specific, but to many industries, and certainly accelerates the deduction for your asset purchases that are often, quite expensive. Another increased depreciation incentive or depreciation tool is called Section 179 expensing. And OB3 increased the annual limit on expensing to 2.5 million, up from 1 million. And then the annual phase down threshold was increased to 4 million, up from 2.5 million. And these are effective for basically calendar year 2025, so current year. And then limits and thresholds are indexed annually for inflation. This is, while an increased benefit, it continues to be limited to net taxable income. So it's less impactful to many horse owners that that have a capital intensive depreciation to and quite frankly use the bonus depreciation now at 100% to write off most of their horse purchase or their horse and farm purchases. So, and it's only available to active trades or businesses. So this is helpful, but not as impactful as the bonus depreciation. And just a brief reminder, because we get this question all the time about who makes the depreciation decisions. So if you are an investor in a syndicate that issues you an annual K1, so it's treated as a partnership, that syndicate manager or the partnership itself will make that depreciation decision as to whether or not bonus depreciation is claimed, and will give you an annual K1 that shows the net result. If instead you are a co-owner of a horse and you treat it as a co-ownership, then each co-owner makes their own depreciation decisions. So again, just a little bit of a difference there to show, just to illustrate who's responsible for making those decisions and what the impact is. Just a brief mention on business interest expense limitation. This really is applicable for larger taxpayers, but we do see it from time to time. So prior to OB3, the business interest deduction was limited 30% of business income before interest and taxes, unless an election to not claim bonus was made. There's a small business exception to this, and which many people qualify in the horse industry. So if your average annual gross receipts are less than 31 million for 2025, this wouldn't apply to you. But sometimes we have people that we get K1s from different businesses, or they have their own businesses that were subject to this. It applies. So I just wanted to briefly mention it to say that it was something that in the past few years that the limitation calculation was significantly reduced because we were not able to add back depreciation. So if you took bonus depreciation this significantly reduced your limitation. With the OB3 passing, it restored the additional add back for depreciation. So the calculation now is similar to an EBITDA type calculation, and basically reverts back to how it used to be calculated. So you're no longer penalized for maximizing tax depreciation, given that it's now added back. And so this would be effective for tax years, for calendar year 2025 for most people. All right, we've come to our first code word. I'm going to stay on here for a little bit just to make sure that everyone who wants CPE, so if you're not doing CPE, you don't have to worry about this. If you are getting your hour of CPE, please make sure you scan your QR code and type in the numbers, or you can go to this website to do so.
Jen, we actually
Yes.
got a question that we could possibly answer while we're waiting for the code words to be submitted.
Sure.
What about homebred yearlings placed in service in fall of 2025? Would they qualify for 100% depreciation?
Well, that's a great question, because I would say that most horse owners qualify for cash basis. So that would be that yearling would have a zero tax basis. If you are capitalizing costs, then we have to think about that, because technically that yearling was born, it could have been foaled or would have been foaled pre 2025. So I think that's a specific question that relates to someone who is capitalizing the stud fee, which doesn't normally happen, and the related carrying costs. And so in general, most of those homebred yearlings would have zero tax basis and it wouldn't matter. But I do think for those that are that have homebreds where they're capitalizing costs, it may not qualify for the 100% bonus. All right, I am going to move along, and we'll go to the next topic here. All right, this is something new, completely new, that came out of OB3, and it relates to qualified farmland sales. And it doesn't change the amount of tax that is due, but it does change the timing of when you might be able to pay the tax. And it seems very specific. And so we'll likely have to have some guidance that's issued as it relates to this. But essentially, OB3 created a updated code section that allows a taxpayer to pay the tax from the gain on the sale of qualified farmland to a qualified farmer in equal installments over a 4-year period versus 100% in the year of sale. Some of the qualifications: the land must be in the U.S. Horses and cattle farms may qualify. The seller must have used the farm for farming purposes for substantially all of the 10 years prior to sale. And the sale document must prohibit the purchaser from using the property from anything other than farming for 10 years after the sale. And this is effective technically for taxable years beginning after July 4th, 2025, which is the date that the bill was signed. So for most individuals, this would be beginning in calendar year 2026. So if I'm a qualified farmer and if I sell a qualified farm to a qualified farmer in 2026, technically the tax, I would have to pay the tax on that gain in by April 15th in general, 2027. This would instead allow me to pay the tax in equal installments from 2027 through 2030. So it does give a little bit of a benefit, obviously, to pay it over a 4-year period versus all at once. There's no guidance issued at this point, so this is new. Guidance will be needed, and hopefully we'll have some time. Given that most folks, most individuals will be on it for this would be for 2026 calendar year, so we've got some time. I did leave the date in there in case we have any fiscal year filers that may take advantage of this. We're a fiscal year that begins after July 4th, 2025. So if you're an August 1st year, beginning of year, this may qualify. You may have some 2025 transactions that could qualify. Again, this is completely new, and I think there's going to be some guidance here. The one thing I'll point out on this in particular is that if you are interested in doing this, that your sale document needs to reflect something. We don't know what that is yet, but something that prohibits the purchaser from using it from anything other than farming. So unlike a lot of the things that we talk about today that are just calculated automatically on on your annual tax return, this is something that would require some upfront consideration. Joe, I'm going to pass it over to you now.
Thank you. So the 199A deduction. So this deduction was originally introduced with the Tax Cuts and Jobs Act back in 2017. And under that prior tax law, this deduction was set to expire at the end of 2025. So really the biggest thing that OB3 does with respect to 199A is it makes the deduction permanent. So, you can expect this going forward. There are some enhancements or modifications that were made, one of which being there's now a $400 minimum deduction that applies for those that have qualified business income of at least $1,000. This isn't significant, but it at least provides some benefit for those that may not historically have gotten much benefit. It also increases the income thresholds that apply to some of the limitations for 199. With the new income thresholds, we may see some scenarios where, owners that previously under the old rules, because they were in a service business, did not qualify for QBI. Now they will, because the income limits are now increased. So just a recap on what 199A or the QBI deduction is. It's a 20% deduction. It's only available to non-C corporate taxpayers, so individuals, trusts, estate owners, and that includes activity from other pass-through entities. The deduction is calculated at the owner or shareholder level or S corp shareholder level. Typically, if you're invested in other pass-through entities, you're going to get the information is going to be included on that K1 for you to do that calculation on your personal return. And again, the deduction is it's exactly what it says it is. It's 20% of qualified business income from all businesses with limitations in certain cases. But the overriding limitation here is that the deduction can't exceed 20% of taxable income, and that excludes that's taxable income excluding net capital gains. There are some additional limitations that I think are beyond the scope of today's presentation that could be related to the ownership structure, kind of what type of business that you're operating. But again, for brevity, I think those are beyond the scope of today's presentation. So just some really quick examples on 199A. Simple case here, individual filer, joint return. They have taxable income of $250,000. They have a boarding and breeding business that generates $300,000 of qualified business income. So the deduction here is going to be the lesser of 20% of your taxable income or 20% of your qualified business income. So in this case, the taxable income is less than the QBI. So your deduction here would be $50,000, which is 20% of the $250,000. Another example here. So same $250,000, except in this scenario, we've got a breeding and boarding business that generates $300,000 of income, but we have a racing activity that generates a $200,000 loss. So again, your deduction for 199A is the lesser of 20% of taxable income or QBI. So in this case, we've got the $250,000, which is taxable income, but our net QBI from all businesses is $100,000. So it's the $300,000 minus $200,000. So in this case, your deduction is limited to $20,000, which is $100,000 times 20%. The overtime exemption. So this is one that got a lot of publicity during the election cycle, and it did eventually make it into the legislation. I think what it ends up being is going to be a little bit different than what maybe people envisioned, and kind of here's why. So the deduction, it's effective for 2025 through 2028 tax years, and it is a deduction for qualified overtime pay. Now, I think one stipulation here is that for purposes of the deduction, the overtime pay is the difference between the regular rate of pay and the premium. So if I'm making $10 an hour and my overtime rate is $15 an hour, the qualified overtime for purposes of this deduction is going to be that $5 premium that I'm getting per hour. It's not I worked 10 hours I worked 50 hours, got $15 an hour. It's I worked 10 hours of overtime times $5. So it's a little bit different than what maybe people thought it was going to be. But the deduction itself, it's taken at the individual level. So it's not something that the employer really has to deal with, other than providing the information to the employee to determine their deduction. Everything that we've seen so far, and there's really not much guidance on this, is that taxes will still need to be withheld by the employer. You may see some updated withholding tables come out, but we haven't seen anything on that yet. It's our understanding that the overtime pay is still going to be subject to FICA and FUTA, just like it always was. But employers will need to be able to provide that qualified overtime number to the employees. And there's no guidance on how to determine that. Maybe it's easy for you, maybe it's not. Maybe we'll get some guidance from Treasury on how to quantify that. But as far as at this point, that's really the only thing that the employer is going to have to do, is just be able to provide that number to the employee. The deduction is capped at $12,500 for a single filer, or $25,000 for married filing jointly. That deduction begins to phase out once modified adjusted income gets to certain levels. So $150,000 for an individual, or $300,000 for a joint filer. And for every $1,000 that your modified AGI exceeds those income levels, your deduction for overtime is reduced by $100. So if you're $20,000 over the threshold, then your qualified overtime deduction is going to be, your maximum is going to be reduced by $2,000. So we may end up seeing some cases where even people that are getting overtime pay are not actually getting a benefit of the deduction, or at least not the benefit they thought they were going to get. Casualty losses. So this is an area of the tax code that you used to see a lot more of it prior to the 2017 tax legislation. Don't really see a ton of it today. And one of the reasons for that is, typically, or at least with the Tax Cuts and Jobs Act, personal casualty losses, they were non-deductible unless they were related to a federally declared disaster. So casualty losses, as you might imagine, they arise from natural disasters, so fires, floods, hurricanes, earthquakes, things like that. And a casualty loss itself arises if your insurance proceeds do not fully replace the lost property. And what I mean by that is the insurance proceeds is less than your adjusted basis in the property. So if you have a home and your adjusted basis in that home is $500,000 and it gets completely destroyed in wildfire, and you get $400,000 of insurance proceeds, then you would have a casualty loss of $100,000 in that scenario. As I mentioned, unless it's a federally declared disaster, then the casualty losses, you can't take a casualty loss. So if your house just catches on fire and burns down, you do not get the casualty loss. But if it's a wildfire and it's a disaster, you could. Um, but even if you get the deduction, there is generally a 10% AGI limitation. So really your loss needs to be greater than 10% of your AGI to really get a tax benefit for it. The one caveat to that is if the disaster is designated as a qualified disaster, and I'll mention a little more about that on the next slide. But in that scenario, the 10% AGI limitation is it goes away. You're not subject to that. So if you jump through all of these hoops and you do get a casualty loss, you have the option to claim that on either the tax return in the year that you incurred the loss, or you can elect to claim it on the prior year tax return. So just a quick example here. So prior to the OB3, those who were impacted by the California wildfires in early 2025, they would have been eligible for a casualty loss because that was a federally declared disaster, but they would have been subject to that 10% AGI floor. So it would have limited any tax benefit. So one thing that OB3 does is it expands that definition of what a qualified disaster is. And it basically includes any disasters declared by the president up to 60 days after the date of enactment of OB3, which in this case was July 4th of 2025. So in that scenario, those impacted by the wildfires, they do get the casualty loss, but they also don't have the 10% floor to deal with either. And I just use the California wildfires as an example because it got a lot of publicity. I would tell you that if you sustain losses in the flooding in Kentucky, or maybe some of the flooding in Texas or New Mexico, or any other disaster for that matter, I would consult your tax advisor because there could be some benefit there, and it could be potentially more than you think it would be. Some updated tax form reporting, so some 1099 updates. I don't think anyone either on my side of the aisle or people that are actually having to file these are going to be upset about this one. So prior to OB3, you were required to issue a 1099 to certain vendors for certain payments if those payments exceeded $600 a year. Now, for the last several years, it does not take a lot to get to that $600 number. So the compliance burden here for quite some time now has been pretty robust. So one thing that OB3 does is it increases that minimum reporting threshold to $2,000, which should ease the compliance burden quite a bit. The bad news is it goes into effect after December 31st of 25. So that means that we still have to do the 2025 1099s based on the $600 rule. And then once the new reporting threshold does go into effect, it will be indexed for inflation. So every year it'll go up a little bit, which kind of makes sense as the cost of things increase. This 1099 threshold, it makes sense that would increase as well. And we are at our second code word or code number. So I'll leave that up here for a little bit so everyone can get it in. Okay, Moving on, hopefully everybody could get that. So some key limitations which may apply. And this one is completely new, so there's now a gambling loss limitation. So prior to OB3, gambling losses, you could take those to the extent of your gambling winnings. So if I won 10,000, I lost 10,000, I could basically wipe out the income and deduct all of my losses up to my income. Unfortunately, as of today, the OB3 has a restriction that only allows you to deduct 90% or gambling losses up to 90% of your taxable or 90% of your gambling winnings. Good news is it doesn't go into effect until 2026, so there's still some time out there for this to change, and there is currently an effort and some pending legislation out there to try to get this back up to that, basically to remove this limitation altogether. Remains to be seen if it gets passed, but at least there is some time before the law goes into effect in case it does. But again, a little example here. I just mentioned under the old law, if I won 10,000 and I lost 10,000, I'd have zero taxable impact. Under OB3, if I won 10,000 and I lost 10,000, I have to pick up $1,000 of gambling income on my tax return and pay taxes on it. So I'm going to hand it back over to Jen.
Thanks, Joe. Okay, here. All right. This provision I'm going to talk about is limitation called the excess business loss limitation. Thankfully, when I look at the end result, not much has changed, but it could have changed a lot. So I just want to walk us all briefly through it, because it is very impactful to many non-corporate owners. It's not equine specific again, but it does impact a lot of horse and farm owners. So this is not, it's non-corporate entities. So individuals, trusts, and estates, and the related flow-through entities. So if you're a partner, if you're an individual and you're a partner in a partnership, or you're an individual that has a single member LLC that is a business, this would apply to you at your individual tax return level. And this didn't exist until the 2017 tax legislation, and then it was subsequently delayed until 2021. So we've been dealing with this for a while now. But essentially, net tax losses in excess of $250,000 for individuals or $500,000 for joint filers, which they're adjusted annually for inflation, are disallowed. And so for 2024, the amounts are $305,000 for individuals and $610,000 for joint filers. And then for 2025, our current year, the scheduled amounts are $313,000 for individuals and $626,000 for joint. So that means it, essentially I am able to claim a net business loss up to that amount, and any excess that's carried over in the current year that's disallowed becomes a net operating loss carryover. And the good thing about net operating loss carryovers is that they're eligible to offset up to 80% of taxable income in subsequent years. So for many, this is a one-year deferral of that excess business loss. So prior to OB3, these pesky excess business loss provisions expired basically beginning in the 2029 year. OB3 makes these permanent. So we are stuck right now with these annual limitations. And the annual limits for taxable years beginning after December 31st, 2025, so that would be 2026 for calendar year taxpayers, are now reset to the $250,000 and the $500,000 for if you're married, which is a temporary decrease. You can see the prior slide talked about $305,000, $313,000, $610,000, $626,000. OB3 temporarily resets these annual amounts to $250,000 and $500,000 for 2026. And then they begin the inflation adjustments in subsequent years. So while on the surface that looks, so inflation adjustments will begin in 2027. So, again, it's a little bit of a decrease, but most importantly, the net operating loss carryover status of the excess business loss was retained. In multiple drafts between the House and the Senate, there was a provision that made a separate basket that basically you would have to have business income to offset your business losses. Many horse and farm owners fund their horse operations with investment income. They may have sold out of a business beforehand, and so primarily generate investment income. So this was going to be a big problem if this created a separate basket. And I'm a numbers person, so I have a numerical example here just to show if I have an annual investment income of 1.5 million and $1 million business loss. What would have happened if the draft legislation passed versus what would happen today. So thankfully. So again, here we've got something where in the top part of this slide, it shows that I have an excess business loss carryover basket that just keeps going and going and not being able to be used until I have other business income. And there was nothing in the draft legislation that addressed what would happen if I ceased business operations. There was no provision from a disposition perspective to be able to claim that. So we were all very excited about the 100% bonus depreciation, but if the draft legislation had passed, it would have significantly reduced or potentially permanently eliminated the benefit of that for many people. And so thankfully under OB3, that did not happen. We still have our excess business loss being treated as a net operating loss carryover, eligible to offset up to 80% of taxable income in subsequent years. So again, thankfully not a ton of changes in this area, but just wanted to point out that that this was a big push for the industry. We've got our last code word up here on the screen, so I'm going to pause here for and let people put that into the phone. So you get for those that are getting CPA credit. Okay, just a few more seconds, and then we're going to go ahead and move on, wrap it up, and then we'll leave some time for questions too at the end. All right. So hobby loss. It's, I always say this is a dirty word for income tax purposes. It's a heads I win, tails you lose scenario for the IRS. Prior to OB3, hobby losses or hobby expenses were completely non-deductible through calendar year 2025. So prior to the 2017 tax legislation, I could claim my hobby expenses up to the amount of income being generated from the hobby endeavor. Pretty similar to gambling losses. But again, once that legislation was passed through calendar 2025, I could no longer deduct any hobby expenses. So I had to pick up all of the income and none of the expenses. The OB3 makes this non-deductible treatment for hobby loss expenses permanent. So I can no longer deduct those. And there was minimal benefit to doing that anyway. So it does make the designation of business versus hobby all the more important, just given that you've got to pick up all of the income and do not get credit for any of the expenses related to a hobby endeavor. So, the IRS regulations list 9 factors for determining whether or not an activity is conducted with the intent to make a profit, and thus a business versus a hobby. And there's no single factor that's determinative. The single most important factor, based on our experience in case law, is the maintenance of good books and records, followed by the development, evaluation, and adjustment of operations to achieve profit potential. I always say to make sure to document. Oftentimes these things get looked at many years after the actual year that we're talking about. And I don't know about you all, but it can be difficult for me to remember what happened last week, much less what happened 3 to 5 years ago. So in any case, again, there's been a lot of activity. So just from a recent IRS audit activity discussion, I spend a lot of my time in IRS controversy work around the country, assisting horse and farm owners. And there has been a large backlog of cases that are finally either getting settled or getting through the system or going to court, but they do seem to be moving. There's been lots of audit activity in recent years. It's certainly slowed down over the past several months, in particular, given the IRS staffing challenges. And we are seeing lots of new agents and lots of appeals officers who may have recently been agents and are acting more like agents than appeals officers. So there is certainly some of that out there, but I always say from a hobby loss perspective, it's always good to be organized, always good to understand the rules. There are specific presumptions. There's a presumption out there that says if I am profitable in 2 out of 7 years, then the IRS has the burden to prove that I am a hobby, not a business. It is often difficult to meet that test, and so most of the times we're looking at the 9 factors. But again, it's just something to consider now, in particular, because you don't want to lose the benefit of your related expenses if you're operating with the intent to make a profit. All right. In summary, let's see what we've got. So we did want to include some non-equine industry considerations because we realize that many horse and farm owners are in other industries as well. We're not going to cover any of these in depth, but some of the more meaningful industry items are listed on this slide, and we thought it might be useful for you to to at least see get a sense of what's out there. But for real estate, the opportunity zones have been extended, enhanced, and expanded to include rural areas as well. And not just some deferral of income tax, et cetera. So those, that's a positive. If you're in the manufacturing sector, that's qualified production property, manufacturing facilities such as factories may qualify for the 100% bonus depreciation. Obviously, those are very expensive, and that would be a nice tax deduction. If the construction occurs between January 19th of 2025 and January 1st of 29, and the facility must be placed in service by January 1 of 31. So that's a positive. U.S. research and development cost expensing, including retroactive relief for small businesses. So if you do a bunch of R&D work and you're under that small business exception, you may be able to get tax relief for that sooner rather than later. Startup ventures, there's some qualified small business stock that there's tiered exclusions from income tax that they've expanded that. And then on the flip side, a reduction of the green credits and the energy credits, the acceleration of eliminating many of these credits. And so if you have projects that you're planning or if projects are in process, you'll want to confirm if there's any impact to those planned tax credits that you may have included in your projections when calculating out the overall cost of the project. Okay, so from an action item perspective, I like to say this, why did you log on today and listen to Joe and I chat about taxes for the last 45 minutes or so? What should you be doing about it? So, consider if any of the OB3 updates impact your 2025 quarterly tax estimates. So as I mentioned, there's additional general tax updates included in OB3 that we didn't cover today because they're very general in nature. But reach out to your tax advisor here or elsewhere to discuss the key tax impacts based on your personal tax situation. Evaluate qualifying asset purchases for appropriate bonus percentage to use in 2025. Again, if you do get audited in 2025, you can expect that the IRS will ask for backup, particularly around that January date. And then determine the OB3 impact to you on state taxes. States may or may not follow provisions included with the new tax legislation, and most states don't, for example, include or use the more favorable bonus depreciation. Some states do, but most states do not. So, and there are several provisions that the states will have to work through to see if they comply or they don't comply automatically and what they might do about it. So I would say that the state impact of the OB3 is a bit up in the air for many right now, just because they're probably working through it. It just got signed into law. If you have a casualty loss, and we use the 2025 California wildfires because we didn't unfortunately have many that were impacted by that. But as Joe said, there could be other disaster areas now that may qualify. Consider if the loss should be claimed with your 2024 income tax return. You can claim either the year of the loss or the year before. Prior to OB3, the California disaster loss could have been claimed in 2024, but it would have been subject to a 10% AGI floor. Now that with OB3, that floor has gone away, so you can get the full benefit of that casualty loss. Monitor as guidance is issued for employers regarding the overtime exemption and related reporting requirements. So again, we have no guidance whatsoever on this topic right now. And so other than really what Joe mentioned today and we went over, but there's got to be some, there will have to be some guidance issued in short order so that employers can address that. And then if you're selling a farm for a gain, consider if the new qualified farmland sale rules apply to you. And again, this requires documentation in the sales contract versus an automatic calculation on the income tax return. This would be a 2026 calendar year item for most. So I see we've got a few questions coming through. Julia,
yeah, we've had a few questions. Yeah, so the first one that we just got is a barn began construction in December and was placed in service in May. Eligible for bonus?
It is eligible for the 40% bonus because it began construction prior to January 20th, 2025.
Another question is, can I prepay 2026 stud fees and still expense them in 2025?
So the answer to that is that you have to have a non-tax reason to do so. So if you are a cash basis taxpayer, you technically can deduct your expenses when paid. However, when prepaying stud fees, there needs to be a non-cash reason to do so in order to deduct a year earlier. So, for example, if I am getting a discount by prepaying, or if I'm getting access to a particular stallion that I wouldn't otherwise have access to by prepaying, those would be examples of non-tax reasons for prepaying stud fees.
Can the bonus depreciation and the land sale tax installment be reversed with a new administration?
Yes, anything is possible, as we've seen with new administrations, and but it would take some tax legislation in order to reverse it. So right now, this is what we have, and unless there is tax legislation that is passed by a subsequent administration, then this is what we'll have. But yes, if we have one administration in power now, if it swings the other way, then we'll have to see what happens. But for right now, it would take actual additional tax legislation to make those changes.
This is the last question from the Q&A portion of the webinar, or at least the Q&A part to submit. In terms of bonus depreciation, if a qualifying asset such as equipment is purchased in Q3 of 2025, does it have to be placed into service in 2025 for deduction purposes, or is it permissible to defer placing into service until 2026?
So yeah, so it really all depends on what you're using that equipment for. So if you're not placing, you can buy it in 2025 and not place it into service until 2026. I would just say that for whatever that equipment is, whatever it's doing, you'd want to be consistent with your methodology. So I mean, most of the time we see equipment being purchased and placed in service upon purchase. But if there was a reason that you were purchasing it in 1 year but not really getting it or not really using it until the subsequent year, I think as long as you're consistent with that methodology, that would be appropriate.
This is the last question we've received in the chat. When does premium OT reporting go into effect? What date? And let me know if that OT should be said differently.
I think this means overtime. Joe, do you know that?
Yeah. So that should be effective for 2025. So between now and the end of the year, I think that's like we're gonna have to figure out kind of how to calculate the amount that gets reported to that employee. But as far as everything I've seen is it's effective as of 2025.
So the beginning of the year. So calendar year 2025.
Kind of retroactive. Yeah.
Yeah. That's what I've read too. Well, good. Anything else?
We still welcome a few questions. We've got a couple minutes left.
No, this is good. I mean, you know, we certainly appreciate the opportunity.
Next slide.
What's that?
Do you want to advance to the next slide so we get contact information?
Sure. Oh, yeah.
While you wrap up?
Oh, yeah. If you think of questions subsequent to right now, Joe and I are certainly happy to answer. We've got our contact information on here. As Julia said, we will, we recorded the webinar today. We'll reach out with the recorded version along with the slides. But if you do have any questions, you can feel free to reach out to either Joe or myself.
We did get one last question. If you have a form 4797 gain larger than your Schedule C loss, does the government consider that a profit year?
They should. They absolutely should. If you've got horse sales on 4797 and you've got a Schedule C or Schedule F, yes, they should look at it combined. I will say that often less experienced agents try to separate out the horse sales from the other activities but really it should be considered one part or one whole. And you know, I think I've seen agents from across the country that are less familiar with the industry try to separate those out, but they should count as you know, the total operation when identifying a profit.
Well, thank you so much, Jen and Joe, and thank you so much, everyone, for joining us. We will be in touch in the coming days with follow-up about CPE and follow-up with materials, but do not hesitate to reach out to your Dean Dorton advisors right now. We are a great resource, and we want to be as helpful as we can during this. Oh, wait, we got one last question. I syndicate mares and profit in 26. Is there any way this is not income?
Can you repeat the question?
Yes, I syndicate mares and profit in 26. Is there any way this is not income?
I don't think so. I mean, I think that sounds like income. I don't quite understand the question, to be honest.
Well, we can reach out to this person and see if they want to expand on it, and we'll get that over to you guys. But thank you so much for attending. Like I said, the materials will be following up with CPE and everything like that. Joe and Jen, big round of applause. Thank you so much.